Can you keep up with the pace of market regulatory reform? MarketsReformWiki.com, the place to keep up.
In terms of who has commented, banking entities, investment banks, insurance companies, funds, foreign governments. Clearly a lot of comments and thoughts. It's been quite thought-provoking. You know, there have been so many points raised. I think I'd like to focus on three. One of the principal comments that has been made is the restrictiveness of the market-making restrictions effectively and how that will impact liquidity. Some view it as it having a negative impact on liquidity. The thought there being that market makers won't be able to provide immediacy in the market in terms of buying and selling securities when a customer needs it, and that could potentially lead to higher bid-ask spreads, higher transaction costs, and potentially even fewer issuance of securities. A second point has been the cost benefit, and here the thought is the benefit to curbing effectively short-term price bets and the impact that could have on safety and soundness or on taxpayers. Does that really outweigh effectively the cost of banking entities having to effectively comply basically with the regulation? And a third really quite important comment has been around the narrowness of the government securities exemption. Here effectively state or obligations of states basically are not exempted, nor are foreign governments, and basically there's been a lot of from certain folks outcry effectively that this could hurt the liquidity of their markets. That said, there has also been a debate as to whether or not there really should be a blanket exemption of foreign government securities, in that there is risk. Current sovereign debt crisis shows that. So how really regulators are going to try to manage that basically is going to be something that they'll have to artfully do really with as they rethink the rule.
The extraterritoriality problem, because there are two components which are in direct opposition to each other. The first component has to do with the instruments that are regulated, and the second has to do with the entities that can trade. And today the Volcker Rule attempts to bridge a very difficult gap, saying that certain securities in the U.S. are exempted, but those same securities outside the U.S. are not. And also saying that certain entities who are affiliated with a U.S. entity but are purely foreign are under the rule. And I think as the regulators deal with this conundrum, it'll probably be the hardest thing they have to construct, is how to walk that very fine line of extraterritoriality.
A foreign entity would be able to engage in proprietary trading if it were solely outside the United States. The issue is it's a very narrow definition. So really what we're talking about here is if it doesn't have a touch point, if the trade doesn't have a touch point with the U.S., i.e. not transacted in the U.S., not with a U.S. counterpart, not with a U.S. person, and also doesn't clear through the U.S. So that is actually pretty narrow. Some of the things that we're seeing with foreign institutions that we've been working with is that trying to isolate, every last touch point with the U.S. is quite challenging, and the data basically within their systems doesn't allow one to do that necessarily systematically. That said, some of the other debate around that though has been that if one were to sort of loosen that, basically, the question is then what impact does that have in terms of the competitive playing field on U.S. institutions? And again, clearly having to basically eye through the needle effectively, that policy, I think it's gonna be a hard one for regulators to look at and think through.
A combination of fixing the rules so that it works and fixing the enforcement of the rules so that it doesn't hamper the business that people are doing. So we'll see two jobs on the regulator's part. One is how do I craft it, and the second is how do I enforce it. And I think one of the areas where we're going to see that is in the three major exemptions that they've already got in the rule. One for underwriting, one for market making, and one for hedging. And already people are saying there are some problems with how you've defined it, and those problems may not be fixable in a rule, only in the enforcement.
Well, what I'm seeing on that point is, really the practical challenges of how to think through, how to basically implement those exemptions. What we see institutions doing is starting effectively with the universe of trading transactions and then saying, well, what is excluded? As example, spot FX, spot commodities, repo, sec lending, U.S. government bonds are out. Then saying, okay, well, what's included? How do you apply those exact exemptions for market making, for risk mitigating hedging, for for underwriting? And then basically how do you drive that down to the trading unit level, which is one of the key concepts within Volcker. Then there's a fair bit of work actually at this point around how do you apply the metrics? What are basically the definition of those metrics? Some of those metrics are already done in-house. Some of them though have slight changes basically, or look at different aspects. Where do you get the data? How basically could you calculate those in a robust manner to basically show the intent, if you will, of what those transactions are, and that they aren't prop. So that's where we really see organizations right now trying to focus effectively.
Part of what people have to do early on is decide what businesses they want to be in. We've already heard some people saying they're going to get out of market making and maybe underwriting, partly because the profitability is not as high as it used to be, but partly because the cost will be higher in terms of documenting all this sort of thing. Once those decisions get made, and some people are hedging on those, once those decisions get made, lots of work can start about how we do it. But without those decisions up front, can we grow our market because other people are leaving? As
institutions try to make those decisions or figure out really what their strategy is going to be, that the initial work really in trying to tag basically, well, would this trade be affected? Would it not? That exercise basically becomes quite important, and making sure you have the right data systems and the right data hierarchies to really be able to pull up the information that's needed to do this analysis is pretty key, not only later in terms of complying, but also I think during the initial decision-making process.
The one thing I've heard which is scary is people saying, I'm not so sure that the Volcker rule is actually going to come to pass. I think maybe it'll be repealed or delayed. And what I tell those people is you've got some time to get some of the things ready, and as more of the rule becomes clear, you have more that you can do. Pushing everything off, thinking maybe this won't happen, is probably not a winning bet.